This is TreppWire Week in Review for week ending May 19th, 2023. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Hendry, Head of CRE and Advisory Services. This week, reported progress on a debt ceiling deal, but a lot of work still ahead. And regulators and former bank executives got some tough questions about recent bank failures from the Senate Banking Committee. In economic data, retail sales showed a modest uptick, and earnings reports from retailers highlight where consumers are still spending. And home prices saw the steepest decline since 2012. Manus, on the regional bank front, turmoil seems to have quieted for now, but we've seen a lot of news about deposit movements and stock movements as well.
Well, the mob moves very quickly. The mob was very complacent and sanguine in late April. They thought that the deposit issues were behind us. All it took was one negative headline from First Republic, the fact that their deposits were down 40%, to trigger a new wave of selling and more concerns that bank failures would be plentiful, culminated with First Republic being taken over. Now, what we've seen after a couple of days of heavy selling last week was a single piece of positive news has changed the tide. Today, Western Alliance came out and said their deposit base had actually grown, which I think took a lot of people by surprise, and that triggered a real melt-up. I guess it was yesterday they made this announcement, but it triggered a melt-up among some of those banks that were really subject to big share price losses over the last 2 weeks. There's no nuance in this market right now, whether it comes to debt ceiling talks, banks, or anything else. Everybody's either all in or all out. And this week, Western Alliance put everybody back all in.
Yeah, I think, and this is going to be the roller coaster we probably ride for the foreseeable future until things completely stabilize. So we're going to have some commentary from some participants at one of our client symposiums this week around this issue, and so we'll let them talk to their positions as well. I had a couple of other nuggets here, Manus and Martha. Retail sales last month showed that the consumers are still resilient. U.S. retailers said sales were up 0.4% in April, and that was tied mostly to strong demand for cars, home projects and online spending. Surprisingly, eating out keeps making the list here as well. So it seems like restaurants are doing pretty well. Restaurant receipts were up about 0.6% and increased for the second month in a row. This is on the heels of 4 months in a row where sales had not been positive. And so before this April's increase, sales had fallen 4 of the 5 previous months. Something else to note on the consumer side is spending on gasoline and big ticket items, furniture, appliances, and others were actually down. And I think, we had some earnings this week. Home Depot was interesting. They missed revenue expectations and lowered their forward-looking forecast, which led to some pretty interesting activity in the market around them. They expect annual sales to decline for the first time in more than a decade. And interestingly, shoplifting appeared in some of their commentary. So an industry term called shrink is what they refer to as theft. And they said that it was one of the main drivers of their lower gross margins. On the positive side, Walmart was up. They beat earnings and revenue expectations, raised their full year forecast. First quarter sales for Walmart were up 8%. And their grocery business really was what was paving the way and offset, a softer market on the clothing and electronics front. And then Target topped expectations, but if you look at their sales numbers year over year, they're relatively flat and really flat relative to the first fiscal quarter. They did warn that a surge in theft, so another large retailer mentioning theft, they estimated theft's going to cost the brand about $500 million more than it did last year. So some interesting takeaways for the big box retailers, both from an earnings perspective and this increasing, theft component in the marketplace.
I'm always perplexed by those that want to shoplift from a Home Depot. I'm not in the mood for like an extra level or a nail gun, or a soldering iron or something like that. I'm sure that there's people out there for whom that is like, a 1951 Mickey Mantle baseball card. But if I'm shoplifting, it's going to be a Brookstone, right? One of those recliners where you stick your feet in and it massages your feet and your neck at the same time. Something, I mean, of course, that's hard to walk out with, of course, especially for a guy my size. But going back to this all in or all out thing, I have to say that I don't talk about the equity markets very much. I don't talk about the overall stock market at all. But this euphoria over banks this week, and what is euphoria front running a debt ceiling deal, which people seem to think is coming, makes me want to be a seller in this market. I've seen the market surge in recent days. I think when we get a debt ceiling deal done, we'll probably see the mother of all rallies. And at that point, I'm a seller. I don't see enough strength in this economy. I see layoffs every week. I see earnings that are middling. I see inflation that is stubbornly high. And I don't see anything that really pushes this market higher on the merits. Now, today, somebody was out there saying that, I think it was Steve Cohen, the owner of the Mets, was saying that AI is going to juice profit margins enormously for companies going forward. And certainly, if we see profit margins widening and earnings exploding, that would be a reason to see a surge in stock prices. But we're so early in the AI game that it's very hard to make that argument. So at this point, I think some of this early euphoria is getting ahead of itself.
As we asked two experts their perspective on the debt ceiling, we had our client symposium today, and these two speakers were here to talk to our clients. And I pulled them aside and asked them what their thoughts were about the debt ceiling. Mike Flood, Senior Vice President at MBA, and Ryan Severino, Chief Economist and Head of U.S. Research at Bentall Green Oak. So these guys know what they're talking about. And here's what Mike Flood said about it.
The end result is, I think we will get a deal. Why do I think that? While both parties are a little bit messy, we haven't defaulted before, and the process looks the same as it has. And let me explain from a DC perspective. Both parties are what I like to call saber rattling. They're telling their base that here are the areas that I'm trying to take on for you. And both parties have done that, and now all of a sudden, here we are with a close deadline, and both the president and the Speaker of the House, the two most important parties, have stood up and said, we will not default on the debt. And third, let's say things go bad like they sometimes do in an argument and things break off. There is a wonderful process in the House whereby if 218 members, regardless of party, decide that they want to bring up a clean debt ceiling passage on the House floor, they can. So while neither party wants to give up on negotiations, if push comes to shove and the leaders can't reach an agreement, the people in the party themselves, Democrats and maybe some moderate Republicans, can get together and say, you know what, we're going to push this through.
Yeah, I mean, I certainly hope we get a deal done. And I think, Mike shares in the optimism that a deal will get done. And even if one doesn't get done timely, there are mechanisms in place to keep the U.S. from defaulting. I would love to see a deal done that includes somewhat of a spending cap. I know that's one of the talking points that the House has come out with. I'd love to see some of this unspent COVID money go back to Treasury. I think anything that puts a little bit of discipline in Washington and removes that inflation accelerator, which is government spending, I think would be well received by the markets. And I think it would be a prudent thing for our country to do.
Yeah, it was really interesting hearing Ryan talk today about, what would happen if the U.S. did default on its debts. And, him being an economist and modeling out, best case, worst case, most likely, and adverse scenarios, et cetera. I think he effectively told the group today the impacts of a U.S. default, he doesn't even think it could be modeled. It could be an incalculable amount of damage to the overall state of the global economy. And so to hear somebody take that position, I think just kind of brings it into focus of how big of an impact getting a deal done really is to the U.S. market and the global economy.
The other big news this week was the testifying of some of the former bank executives in front of the Senate Banking Committee, and there was anger coming from both sides of the aisle aimed at these gentlemen.
There sure was, and rightly so. I think both the right and the left really pointed fingers at the mismanagement of SVB. I was actually quite impressed by one of the questions. You were talking about this before, Martha. Somebody said anybody on this planet could see that higher interest rates were coming, and you allowed your book to be unhedged. The fact that a member of Congress understood hedging, what that meant, asset liability matching, risk management, or anything like that, I thought was incredibly impressive. So kudos to the congressman who pulled hedging out of their back pocket for that line of inquiry.
Yeah, it was interesting too. The congressperson Brown from Ohio, effectively laid the blame squarely on the feet of the executives. I think the quote was, "We know your banks were fatally mismanaged. The next obvious question is why? Why did you let things get this bad?" So, to your point, Manus, they came out hot.
Yes, no mincing words on the part of Senator Brown.
And in a separate hearing on Tuesday, bank regulators were asked what regulatory changes might be ahead as a result of the turmoil. Again, we asked Mike Flood from the MBA what he sees. He focuses on regulatory governmental changes, and here's what he said about what he thinks is coming.
We believe that regional banks between 100 and 250 billion in assets under management will likely face increased scrutiny in the form of three varieties. One, likely a look at whether they should have increased capital over the long term. Two, likely increased stress tests or inclusion of stress tests if they haven't had them before. And three, the examination, as you can imagine, are probably going to be a little more diligent as they look over the portfolios.
He also went on to say that we're not in a liquidity crisis, but a price discovery crisis.
Well, Mike, who's been a guest on our podcast a couple times and really has his finger on the pulse, I really appreciate what he has to say, and I value what he has to say. And I think that the narrative coming from me and others on this podcast has been, we are likely in a liquidity squeeze, that banks are holding on to deposits, lending very carefully, and keeping their powder dry, so to speak. To hear Mike come out and say that we are not in a liquidity problem, and he's a guy that speaks to banks every single day, multiple banks every day, to hear him say that was very comforting. The fact that he thinks that we are not in a liquidity squeeze, and hopefully that's right. Hopefully banks are lending, the valves are open, and commercial real estate is not getting constrained.
Yeah, it seemed like the sentiment from a lot of the participants in the symposium was just that, Manus, that capital is available. Banks understand they have to make good on their depositors. Like if someone has a relationship with that institution and brings a deal, they have to figure out a way to get those deals that pencil loans made. And so it'll be interesting to see, how this continues to play out, because I do think the price discovery or lack thereof could become overbearing for some of these banks, because at some point you have to be able to underwrite to something. And if you don't know what a cap rate is, and you don't know what sales prices should be, you don't know what stabilized occupancy is. We've talked about this at length. It makes it very difficult for you to really be comfortable making loans. And so I agree with you. It's positive that Mike feels like there's availability of capital in the market. And hopefully this price discovery comes at a point where it's advantageous for borrowers, banks, buyers, sellers, et cetera. And it's not so, damning that properties are being sold at 40 cents on the dollar.
And I don't want to get too far into the podcast without bringing this up, and that is the passing of Sam Zell today. Talk about a guy, an iconic figure in our industry, in commercial real estate. Maybe nobody ever better at knowing when to hold them and knowing when to fold them, to quote Kenny Rogers from back in the day. Sam Zell famously selling equity office in 2007 before the economy went off the rails, really at peak value for $39 billion, really cemented his legacy, always a pleasant guest on CNBC and other programs. And I think for guys like us in the CRE market, the CRE space, somebody we really looked up to in terms of his opinions, his sense of humor, his color. And, the industry really lost a real giant today with his passing.
It's been really cool to see a lot of people that are, people like you and me and Martha, in the markets, normal CRE folks that have photos with Sam Zell or have some sort of anecdote where they ran into him at a conference or saw him present and he took time out and met with them. And to your point, man, it's just a really like a titan of industry for the CRE marketplace for sure.
And a lot of the things that we're hearing, staying on the subject of banks, from many of the people that are now doing the sifting through the rubble of what's happened to these failed banks, is their concentration risk. So you hear a lot of talk about concentration risk, especially with everyone focused on what's happening in commercial real estate. So our team took a look at bank concentration risk in a couple of key areas that we think would be very interesting to many of the CRE investors in the market.
Yeah, and I think this comes on the heels of Signature Bank, where 40% of their total deposits could be tracked back to just 60 customers. 14% of that was just tied to 4 depositors. And so, having high levels of concentration, whether it be by property type or by depositor, can really cause problems. And so to your intro, Martha, we did look at CRE concentration ratios, which is a metric that measures the extent that banks' loan portfolios consist of CRE or commercial property or multifamily mortgages. It also includes construction and land loans. And there are some guidance levels that are put out by regulators for when banks are stress testing that we used in our analysis. So 300% concentration ratio is considered, guidance for CRE loans, and 100% concentration ratio for construction loans. We went through and looked at those two metrics and tried to identify banks in which they exceeded one or both of those metrics. So just some high level here. And again, we can make the full report available for you if you're interested. Just reach out to podcast@trepp.com. Of the 4,700 plus banks that we reviewed, there was about 763 banks that had one of those ratios where they exceeded the threshold. And there was about 150 banks where both of those ratios were above the threshold. And so we have it broken down by assets and give you a breakdown of the corresponding number of banks and the percentage of the banks within that strata and how they fell out. So really interesting piece. And I think it's definitely something that people will be keeping a closer eye on going forward with the banking turmoil.
And to be clear, these ratios, by the way, what they do is they require a higher level of scrutiny. A bank can go above 300% in terms of commercial real estate holdings, in terms of percentage of equity. But once it does, it requires a whole nother level of regulator scrutiny. So we certainly don't want to cast any aspersions against banks, and nor do we in our report. It's just a highlight of where these concentrations lie and where the big lenders of commercial real estate have been. But it's a great report.
And thanks to Emily Yu, who helped put that report together. So let's get through some of the property sectors. I know, Manus, we have a lot of news to cover this week. And
you want to spin the property type wheel of fortune to come up with which one we start with? Is that
I think we should. I think everyone is talking office right now, so let's give them office.
Okay, I'll try to break these down into categories, and I'll take a deep breath between the various segments. So I'll start off with loans that either went to special servicing this week or went 30 days delinquent. The first one, which got a lot of traffic in the press, was Brookfield. Their fund, the DTLA fund, which our sister company, Commercial Real Estate Direct, a few weeks ago pointed out had issued a going concern notice and had already become delinquent on the gas company tower and World Trade Center property in Los Angeles. This month, they went delinquent on EY Plaza in Los Angeles, and that loan has been transferred to special servicing. That is a $275 million note. And by all indications, it looks like this particular asset is headed back to the lenders. Maybe too early to tell, but we'll watch that one. Trouble in the Heartland, that was our headline for this one. Most of our special servicing transfers have been in LA, San Francisco, New York, or Chicago. This one comes from Kansas. The $232 million Aspiria office campus loan has been sent to special servicing and is facing imminent default. The loan does not mature until August of 2023. This could be a situation where the borrowers are trying to get ahead of what will be a difficult extension conversation. That's always the possibility. The property backs a big loan that was securitized in 2021. This particular property, 3.7 million square feet in Overland Park, Kansas. It was once the headquarters of Sprint. Sprint and T-Mobile merged. And ever since that's taken place, Sprint has been gradually reducing its office space there. So that big $230 million loan goes to special servicing. Back to Los Angeles, the Wilshire Courtyard loan also sent to special servicing in May. That's a $410 million loan. It matures in July. We've written about this extensively over the last couple of months. In January, it had some momentum. Sony Pictures had added 200,000 square feet. It looked like that was going to push occupancy back up above 70% at that particular property. Since then, two tenants have announced they were leaving, Media Brands and Skydance Media, which all but offsets the Sony lease. Occupancy has been in the mid 50s since 2021. So another one there. In Chicago, River Point North, that's a 1.7 million square foot mixed use asset. It also has a maturity date in 2023 in July. It has two more extension options. Again, this could be a case where the borrower just wants to get into the queue for an extension, but doesn't qualify on a debt yield basis and is just trying to get the workout specialist's attention, but we don't know at this point. Lastly, in Virginia, the $84 million Plaza Americas Towers loan also spent to special servicing. This is a CMBX 7 deal. The property is about 500,000 square feet, and it represents 2 of 4 properties in a big complex in Reston, Virginia. So that's the big special servicing transfers this week.
Yeah, so I think just with those loans by themselves, man, it's like that probably has the potential to move the special servicing rate up this upcoming month measurably. I mean, those are some pretty big deals. The property in Overland Park, I don't think we mentioned the occupancy on that one, but after Sprint and T-Mobile, started to vacate the property, occupancy is down to about 63% at the end of 2022, which was about 16% less than what it was underwritten at origination. Not surprising, not shocking really with any of these stories. I mean, when Brookfield's talking about the fund itself being, potentially no longer a viable going concern, obviously all the assets in that fund, I think we're going to see more of these, unfortunately before it gets better. I mean, that's just the reality that we're in. I think you brought up some interesting points though. Are these really just positioning or posturing to try to get in the queue to get a little more favorable extension workout or something else? Or are these really properties that ultimately end up going back? I think that's the question for myself and others, where we're just not sure what the answer is, but sounds like we're getting closer to finding out here.
Yeah, I think by October, we should have a pretty good sense of which way the wind is blowing for these office owners, who's leaning in and who's not. If interest rates stay high, if demand stays tepid, and if we see more subleasing space come on the market, I think those will blow an ill wind, as they say. Where isn't it a Bob Dylan line, and an ill wind is blowing or something like that, right? I think that, the market could use some more demand. It could use a leveling off of sublease space, and they could use some lower interest rates. So let me turn my attention now to, and I'll rattle these off quickly, subleasings that took place over the last week or so. In Chicago, we have Groupon. They put back, I think it's 300,000 square feet in the Windy City. In New York, Spotify at World Trade Center downtown, 85,000 square feet. In North Austin, a market that has been surprisingly hard hit in recent weeks with sublease space, 3M, 204,000 square feet. That's in the Palmer complex in North Austin. And a little bit later, it was Home Depot announcing it was putting 200,000 square feet of space. The Austin Business Journal pointed out that In addition to those two, TikTok, Meta, and Workrise have also put space out for sublease in Austin. So for that particular market, that's an awful lot of names in what is not a huge office market. Elsewhere in San Francisco, Uber put 300,000 square feet of space, which they never took possession of. That's at 1455 Market in the Bay Area. So more troublesome signs of subleasing space across many cities.
Yeah, if we circle back to Austin there, man, it's the Home Depot announcement. It's interesting because that was actually, it's their technology center. So it's actually like a Home Depot office space that they use to create new technologies for some of their storefronts. And so it's a pretty large swath, 200,000 square foot for sublease. And then, just on Austin generally, we had talked about this kind of early post-pandemic, I guess, when Meta and TikTok and a lot of these other folks were taking on just enormous new leases and square footage. And I remember you and I talking about, what is the in play? And we talked about some of the risks for markets like Austin that maybe aren't as well diversified. And it seems really great on the front end to get these long-term leases in place with, credit tenants that are tech-based. But unfortunately, they're seeing the other side of that now. So, these will be guaranteed leases. These are just available for sublease. It's not like they're losing money, but it does definitely negatively impact their chances for refinance and other, market pricing, as we talked about some of the repricing that's potentially coming down the line.
One sublease I forgot to mention, Roku in the Coleman High Line. I think there was another firm out there. It was Verizon and or Facebook were both giving up space in the Coleman High Line too. That has been a real star in terms of attracting big tech names in recent years. So a little reversal of fortune there. It looks like Roku is giving up about 360,000 square feet. The interesting thing, Lonnie, there is the sublease is being offered at slightly higher rent than what Roku is currently paying. I think they're paying 45 or 46 bucks a square foot, and the asking rent on the sublease is 48. So this might have a happy ending, this particular story.
Yeah, it'd be interesting to see what the market's reaction to that is. And, there could be a number of factors as to why they think the space is worth more today. Usually you don't have a positive leasehold position in a market like what we're in right now, but they might have done some, extraordinary TIs and finish outs on their own that maybe justifies a slight increase in the rent. We'll see how that plays out.
Maybe it's a few free subscriptions, right? You take 300,000 square feet and we'll give you 75 Roku subscriptions and the new device that goes with it.
And so I think you have, to finish us out, some comps in some areas of interest.
Have we gone too far on office?
We've never gone too far.
All right. A couple of things in comps. In San Francisco, we had talked a couple of weeks ago about 350 California being offered for 25% of what it was valued at just a couple of years ago. That sale went through for something like $60 million. BizNow is now reporting, citing Real Estate Alert, that 2 San Francisco offices are really being shopped at bargain basement prices. One is 123 Townsend, which is being offered for $90 million. That property sold for $140 million about 3 years ago. I think that might have been once Pinterest's headquarters, if I'm not mistaken. It once backed the CMBS loan, but that loan is defeased, so breathe easier there. The piece also notes that 60 Spear Street has been listed for $55 million, which is a 50% discount to where this thing sold in 2022. So 1 year later, 50% price reduction. Ouch. In Tampa, lastly, Ally Capital has acquired 1 and 2 Urban Center in Tampa for $123 million. This is good news, bad news. The bad news side of it is in 2018, this property sold for $143 million. So $20 million discount, but you could probably chalk that up into higher cap rates alone, pushing that price down. The good news is anytime in this market you see a 9-figure sale price for an office, you take what you can get. And to see something sell for $123 million is a green shoot in a market that has seen very few in recent months.
Yeah, and the seller on that transaction was Starwood. So it's interesting to see them offloading that office property at a discount, but feeling like that was the right strategic move for them.
All right, because it's retail earnings week, we're going to now move on to retail.
All right, so I'll start with the downside. This came out today. It was circulating on Twitter. Dan McNamara was the guy putting these stories out. This is a really negative story for the mall space. So a 2012 deal that is part of CMBX 6, UBS BB 2012 C2 had two malls out for auction this week. One was the Crystal Mall in Connecticut. The second was the Louis Joliet Mall, which I think is in Ohio, both out for auction. The results were nothing short of dismal, to the extent that we can confirm the Twitter results, which we haven't confirmed yet, but we are relying on them here. The Crystal Mall had an outstanding balance of $81 million. Top bid was set to be $9.25 million. So this is a $72 million loss waiting to happen. The most recent appraised value on that property was $13.5 million. So the auction results were even worse than what was a really, really downbeat most recent appraisal. The Louis Joliet Mall, I guess you could argue this was even worse. $83 million outstanding balance. The most recent appraised value was $48 million. The top sale price came in at $30 million. So $18 million below what people were hoping to get on a value basis. In total, $22 million from those two properties alone below what people were hoping for. What does that mean for bondholders? What it means is classes E, F, and G from that deal will be wiped out in full. Class D, which was rated BBB plus at securitization, will also be either wiped out in full or in almost full. And it's not out of the question that losses could touch what was the single A piece in 2012, the C class. So we've been waiting for that day when we would see some of these things start to clear. And this was not a good day for valuations.
I'm reminded of a Snoop Dogg lyric, drop it like it's hot, because that's what happened, it seems like here, and the losses are real. And unfortunately, this is the negative side of the equation that we've been talking about for some time. When we see this in the market, the fallout, I mean, some of these things can be sizable and the impacts can be pretty far reaching.
I'll cut through one or two more negative stories, but there were some good stories out there today, and I do want to touch upon them. The mall at Tuttle Crossing, this is in Dublin, Ohio. This went to special servicing in 2020, has been delinquent for most of the last 3 years. It backs an $81 million CMBS loan. The deal is part of CMBX 7. That particular property, the value there was cut from $49 million this month to just $29 million. So that looks like this is more like about $105 million loan. I misspoke. This looks like another big 60, 70, $80 million loss coming down the road. Seeing this cut by almost 50% this month puts it on that trajectory. So let's turn our attention to a couple of positive stories here in the retail space. The shops at Mission Viejo, that particular loan, it backs a single asset 2013 deal. That loan was extended 1 year. In addition, the most recent value, while cut, remains above the outstanding balance of the loan. So we feel pretty good about that. According to Commercial Real Estate Direct, the Cumberland Mall in Atlanta has been refinanced. This is a 550,000 square foot mall near the Braves ballpark. They got new refinancing. That new refinancing has found its way into two 2023 CMBS deals. That new refinancing will repay a $160 million loan that was securitized in 2013 and which backs CMBX 7. This one, a little bit out of the blue. This is one of the Starwood multi-pack retail loans. The Starwood mall portfolio that was issued in 2014 backs a $680 million loan. The value of the collateral had been cut to $200 million in 2021. This month's servicer data shows the value being upped to almost 300 million. So a recovery of value of nearly $100 million on a deeply, deeply dented portfolio backed by 4 malls in several states around the US. And I did have one more positive story also from May servicer data. The OKC Outlets loan has been extended for 2 years. This is a 400,000 square foot factory outlet property in Oklahoma City. The property was valued at 144 million in 2017, cut to 106 million in 2022. The loan has been in purgatory for about a year. This month, we got word that this thing has been extended. So between that and the shops at Mission Viejo and the uptick in the Starwood valuation, not all is bad in the retail space.
Yeah, I think on the Starwood portfolio, something to note there is that loan actually had a maturity scheduled for November of 17, got a 2-year extension through 19, and here we are in 23. So it's good to see some positive value being added back to that portfolio. Still considerably less than the loan amount, but hopefully there's still some opportunity to make that viable into the future.
All right. I think, Manus, let's end on an upbeat note. Let's go to hotels.
Yeah, we got a couple of good stories here. It's always good to end on an upbeat note. And as I wrote in our TreppWire this week, I always liked a good comeback story. Just a little bit behind the scenes about me personally. I do cry at almost everything I see on TV. It could be even the dopiest cartoon movie. They all pull at my heartstrings. So I'm a sucker for Hoosiers and other big comeback movies. So I love this first story. The $36 million Beach House Hilton Head loan. This was paid off this month. Not only was it paid off, it was paid off with a 4% prepayment premium, which was the floor of the yield maintenance calculation. The loan made up over 5% of a 2015 loan. Why do we love this? We love this because this particular loan saw DSCR drop to 0.5x in 2020. Occupancy fell to 49% that year. The value of the property was cut by 20%. And here we are 2 years later, the loan pays off in full with a prepayment premium. So cue up that sentimental Hoosiers music. This is a great comeback story. And I do have one other, which I like as well. This is a trading alert we put out this week. May servicer data indicated that the W Hotel in Minneapolis, that loan has been extended. The term has been extended for 12 months. The Trepp cash flow models were updated early this week to reflect the new term. The property is a 229-key full-service hotel in Minneapolis. It makes up 72%, the loan does, of a 2013 CMBS deal. The property, just like the Hilton Head property, was really punished over the recent years. In fact, in 2022, debt service coverage ratio was still under 1.0x and occupancy was 54%. We've talked over and over again about how heavily hit Minneapolis has been by corporate vacancies, departures. That economy between companies downsizing and quality of life issues has been hard hit. But what we have here is Benefit Street Partners, the mezz lender that took over the property a couple of years ago from Ashford Hospitality, leaning in, getting that extension, fighting for the property. So 2 really nice stories to end with in the hotel segment.
Programming note, our team is going to be in Silicon Valley at the NAIOP Capital Markets event. The event is Wednesday, May 24th in Santa Clara. If you're interested in attending and you're out that way, there's time to register. Have a look. We will be there recording our podcast. So should be fun. And they're actually going to take us on a tour of some commercial real estate buildings and some other locations. So we'll learn some things while we're there.
We're really looking forward to it. I mean, we had such a great success with the Detroit live recording, and we think this will be just as good in sunny California, even though the Bay Area is not as sunny, but still looking forward to it.
And shout outs to Mark R. and Brett K. for coordinating this with our team. A number of shout outs. Joel P. We met at our client event this week. He told us his team, and it's a number of them, listen to the podcast every Friday. Sejen, who is a colleague of Susie, says they're a big fan of the podcast. Shay J, another client, also let Susie and Sonal know that they love the podcast, listen every week. New hire Eric B loves the pod, says he's a loyal listener. Larissa R sent us an email after we discussed affordable housing, has some interest in this topic and wanted some follow-up information. Royden H looking for some of our bank analysis, and Sophia D interested in the retail data. Melody W on Twitter said, really good podcast on sublease rents, and that might be the next mole to whack in CRE. Love the primer on street rent versus effective rent. So kudos to Lonnie for doing that one. And she gave a shout out to Xander S for introducing her to the podcast. She also liked the discussion on the Toast Boston story, was interesting to her, Manis. So that was aimed at you. Ben P jumped in on the thread and said the podcast is a weekly must. And Martin K is interested in some of the analysis we did on banks. And Jonathan L is interested in listening. Anyone who wants to understand the changing world of commercial real estate and its impact on the bank sector. Thank you guys for a relaxed but informative session every week. So I don't know, you guys feeling relaxed?
Well, I want to give a shout out. I finished teaching at Clemson this semester, 51 men and women, young men and women that were dutifully listening to me, painfully perhaps at times, but I know many of them listen to the podcast. I want to thank them for that, thank them for their attentiveness. And I got to say, they were really top-notch students, polite, inquisitive, and it was a real pleasure to take part in that. I could really have to say they were top-notch.
We're going to read your teacher evaluations later, Manis.
Well, it's a funny thing, if I don't know if our listeners are churchgoers, but I remember when I was a kid, going, you always expected a certain thing when you went there with your parents, right? If the guy spoke, he gave a sermon for 10 minutes, you felt like you were ahead of the game. 15 minutes, you got what you were, bargained for. 20 minutes, wrap it up already. That's enough. And there I was twice a week having to speak for 75 minutes. So a lot of those times I thought, man, certainly these kids want to stone me today. Like I didn't show movies, no guest speakers, just me marching back and forth, in full Ted Lasso mode with 80s references and bad analogies, trying to speak to 21-year-olds. But I got to say, smart kids, top notch, and incredibly polite.
And one last shout out. We talked to Oz. We actually met Oz in person. We've had him on the podcast, and he's been a frequent contributor to commentary and had some great things to say about the podcast. Says that we got him through some of the dark times during the pandemic. So he thanked us for that. And congratulations to his son, who I believe is graduating. So thanks, Oz, for the kind words. And with that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or a comment, send your email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Thank you for listening, and stay well.
All right.